is something new in the new syllabus. So capital budgeting, the basics of which we have done at intermediate level. So maybe we would have forgotten. And let me just tell you that in earlier classes we have discussed about what is PV factor and what is the NPV and all that. Right. So impact of inflation in capital budgeting decision. So something on the basics in the first few classes of SFM we would have done. Say 1 plus M equal to 1 plus R into 1 plus I. M stands for monetary or nominal. R stands for real. I stands for inflation. Correct? Certain assumptions that we normally make in capital budgeting. One of the basic assumptions that we make is that the cash flow is real cash flow. What do you mean by real cash flow? Real cash flow would mean cash flow devoid of inflation. What do you mean by devoid? Without inflation. That means the understanding that you're going to bring out is that real cash flow is without the factor of inflation. Real cash flow is without the factor of inflation. When the problem is silent, what sort of cash flow we are having? Real cash flow. Real cash flow is a cash flow without inflation. Then real cash flows are to be discounted by real cost of capital. Real cash flows are to be discounted only by real cost of capital. Correct? See, it is like the hero of a movie will tell he is a good person for good people. Good. Real. And he will go on commenting saying that he is the worst person for bad people. நல்லவனுக்கு நல்லவன் கெட்டவனுக்கு ரொம்ப கெட்டவன். So, what is the opposite of real cash flow? Nominal cash flow. Nominal cash flows are to be discounted by nominal cash flow, nominal cost of capital. Nominal cash flows are to be discounted by nominal cost of capital. Nominal. Now, I will take up an example, then you can easily understand what exactly is the catch there. What is the catch that we have? I have 4 years, 1, 2, 3, 4. Real cash flow, 10,000, 15,000, 27,000, 20,000. My PV factor is taken up at 10%. Discounted cash flow. Now this is real cash flow. Now assume an inflation factor of 2%. Number one, find out nominal cash flows for all the 4 years. Then find out nominal cost of capital. Find sum of discounted nominal cash flows using nominal cost of capital. There are three questions that you have. So find out nominal cash flows for all the 4 years. Would mean what I do is that I take up real cash flows. I will simply copy. Nominal cash flows I will bring in. How to? Watch carefully. 10,000 multiplied by 1.02 to the power 1. Correct? Say, sir, no, are you clear? Are you clear? If it were to be 10,000 without inflation, adding 2% on 10,000 for 1 year, I will take it up like this. Is it right? Please put it in mute mode. Next. Next year, it is not 2% on 15,000. 2% 2 times. Why 2 times? Because it is occurring in year number 2. So, therefore, it is 10,000 into 1.02 to the power 1. Here it is 15,000. Here it is 27,000. Here it is how much? 20,000. Are you clear? This you have to make note. So here you cannot be just telling I will do it later. Are you noting down? Pad agar pad. So I have answered to the first part of the question. Are you clear? Why it is to the power of 2, why it is to the power of 3 is that you are doing it for the second year, third year and all that. It is not simply 1-2%. There is only once that 2% applied on real cash flow. Are you clear? then 1 plus m equal to 1 plus r into 1 plus I. Correct? If I have to find out m is equal to 1 plus r into 1 plus I minus 1. Correct? Keeping that, what I just get is m is equal to 1 plus 0.10 into 1 plus 0.02 minus 1. How much is that? It is 12.2 percentage. Nominal cash flows are multiplied by nominal cost of capital. What? 10 percentage is cost of capital, 10%. That is originally their real cost of capital. Just see, there is a small change in the because of the approximation. 9091, 12396, 12397, 2285, 2286, 13660, 13661. So both will give you the same answer. Are you clear? Is that okay? Have you copied? Have you copied?
Yes, sir.
Yes,
Right.
sir.
That we have just taken up. See here, illustration number 1, determine NPV of the project with the following. Initial outlay 40,000, annual revenue without inflation 30,000, annual cost excluding depreciation without inflation 10,000, useful life 4 years, salvage value nil, tax rate is 40%. Cost of capital including inflation premium of 10% is 12%. We are expected to find out NPV. How do we do that? So now let us just take up the computation of cash flow. Illustration number 1, revenue 30, cost 10, depreciation 40,000 minus 0 divided by 4. Why? 40,000 is the cost, salvage value is nil, 4 years useful life, depreciation is 10,000, profit before taxation is 10,000. How come? We have deducted these two from revenue to get this. Tax at the rate of 50% would mean 5,000. Profit after taxation is 5,000. Cash inflow is equal to PAT plus depreciation. Therefore, it is 15,000. Correct? Are you understanding? So, if this is causing you confusion that we are having negative and all that, so I would just this being 20,000, you are taking it up like that. So, cash inflow is 15,000. Then here you have cost of capital including inflation premium of 10% is 12. So R is equal to 1 plus M. See, you know that it is 1 plus M equal to 1 plus R into 1 plus I. I know this rate. I know this rate. But what I do not know is R. This is 1 plus 0.12 equal to 1 plus R. I do not know. But I know it is 1 plus 0.10. Right? They have given it as 10%. So therefore, 1.12 divided by 1.10 equal to 1 plus R. So 1.12 divided by 1.10 minus 1 equal to R. How much is that? Please use your calculator and get me the number, please. So 1.82%. So R is equal to 1.82%. So the question what they have asked is that find out the NPV. So we can do that here 1, 2, 3 and 4. What is the cash flow?
ஒரே
15,000.
நிமிஷம் ஒரே நிமிஷம் let us check the inflation rate. I think it's 2%. Just check the question.
Inflation
Power.
premium is 10%.
Okay.
PVF 1.82%. 1 divided by 1.0182 to the power of this comma 4 round. Discounted cash inflow So discounted cash outflow is 40,000. NPV is equal to this much. So if it were to be a cash flow which you consider as nominal, how much is the inflation I am expected to take up on to the real into 1.10 to the power 1 comma 0. It should have been 16,500. So our PV factor at 12%. Discounted cash inflow 16,500 multiplied by this. Just see, they are almost the same. Okay, that's it. What do you have in this case? 17,369. 17,369 or 70. That's not a matter at all. So this is the way you got to do. Come on, kindly just make note of this one. If you have copied, please let me know. Then I will push to Excel.
Copied, sir.
Copied. Okay, come on, kindly just make note.
Sir, one doubt, sir.
Yeah, what is that?
Sir, how cash flow nominal is worked out, sir? Uh,
How we have worked out in the last problem, same way only we have done here.
so 15,000 into 1.02 power 1, right, sir?
Yeah, one moment, I will just show you. 15,000 into 1.10 to the power 1. That and similarly 15,000 into 1.10 to the power 2 and so on.
Okay, sir. Thank you. Done, sir.
Okay. If that is okay, then we shall go to the next one. Have you noted? Illustration number 2. Yes. Vanessa, could you read out?
Yes, sir. XYZ Limited requires rupees 8 lakhs for a unit. Useful life of project 4 years. Salvage value nil. Depreciation charge rupees 2 lakh per annum. Expected revenues and costs excluding depreciation, ignoring inflation. Year 4 years revenues and costs are given. Tax rate 60%. Cost of capital 10% including inflation premium. Calculate NPV of the project if inflation rates for revenues and costs are as follows. Revenues, costs.
That's all. They given revenues at different rates. What would you do? Say where you have different rates for revenue, different rates for cost. What would you do? Are you understanding what exactly is the question? Tax rate is 60%, cost of capital 10%, including inflation premium. What shall we do? You have done the sum. Yes. Hmm. Okay. So our friend Venkat Raj is there. So I will allow him to talk. Will you be explaining because others are not hearing you?
Audible. Is it audible? How we have to do is that first we have to do revenue minus cost. That is in just in simple accounting terms, sales less cost. then we have to add the depreciation considering the tax effect. Then we'll arrive the amount, and we have to be careful over here. Revenue every year we have to do like how the bond valuation every year we have to multiply 1.10. Then subsequently, even for cost, we have to give the change. Then we have to we have to arrive by, using the cost of capital as 10%, assuming it's real cost of capital. Real only, sir. Real only, sir. Assume to be real, sir. Sir, that's what.
See here, cost of capital is 10% including inflation premium. If that be the case, how can you assume that 10% is without inflation? They are telling Kamal is a boy. How can you define that Kamal is a girl? They given it is including inflation premium nominal. How can you assume that it is real? I never taught you tax effect on depreciation. I never did that. So just see, that's how we work. So here 1, 2, 3, 4. Ignoring inflation, these numbers 6, 7, 8, 8, 8. So before that, let me just bring out depreciation. Depreciation charges 200 lakhs. $200,000, okay? Revenue without inflation. How much is the number? 6788. 600,000. Inflation percentage 10987. Correct? With the inflation revenue, how will you do that? How will you do that? Come on.
600,000 plus 10% of 600,000.
This is first year anybody will do.
1.1 into 1.09 second year.
One moment. 1 plus
1.1 into
one moment. Pavan, please tell what is that you should do for second year.
Second year it is 700,000 into 1 plus 0.09 into 1 plus 0.1.
So what you say is this into 1.1 into 1.09. Correct?
Yes, sir.
This is what you want to tell.
Yes, sir.
Are you understanding? Others?
Yes, sir.
Yes, sir.
Vanessa and Sivagama Sundari?
Yes, sir.
Yes, sir.
Right. See, imagine if it were to be 10% throughout, what would have been the case here? I would have taken up 700,000 multiplied by 1.10 to the power 2. They did not do that. So what we have just done is right. equal to round 800,000 into 1.1 into 1.09 into 1.08, comma 0. Correct? Here, around 800,000 into 1.1 into 1.09 into 1.08 into 1.07, comma 0. Are you understanding? Say yes or no?
Yes, sir.
Yes, sir.
Without I cost. Without I, the cost. 3444. Inflation percentage. What is the inflation percentage? 12, 10, 9, 8. 12, 10, 9, 8. Correct? With inflation cost. How is that we have to do? Into 1.12. Correct? Into 1.12 into 1.10. Correct? Equal to 400,000 into 1.12 into 1.10 into 1.09. Correct? Into same figure only into 1.08. Because I have already done this. 1.12, 1.10, 1.09. Are you understanding? Is that right? Say yes or no.
Yes.
Then profit before depreciation. What is profit before depreciation? This minus this. Now, profit before taxation equal to profit before depreciation minus depreciation. This minus 200,000. Correct? Then this is going to be profit after taxation. This number multiplied by 40% only because 60% is tax rate. Cash inflow equal to PAT plus depreciation. PV factor at the rate of 10%. Is that right? Round 1 divided by 1.10 to the power discounted cash inflow. Round this into this. Discounted cash outflow. How much? 8 lakhs. NPV is equal to 106,968. 106,968 because of rounding off. Here they have just mentioned it only for 3 decimals,
Three
whereas we have
decimals.
done it for. So if you want that to exactly match, we can just do that. No big deal. 106, 744, 106, 6 rupees difference you have. See, it's a very simple matter, but thing is that you got to do a lot of work. Come on, please make note of this. So tax saving on depreciation or all that you don't do. You incorporate like this. For every problem, you use the same format. Correct? Come on, kindly make note. See, this is about illustration 2 of chapter 3. Advanced. What is the title? No, this particular advanced issues in capital budgeting. So it is illustration number 2. We are doing it in a particular way where we will maintain consistency. In every problem, institute would be working in a way that is convenient to him, but we are following a uniform model. So if you are late, you can take a screen capture and keep it. And I would like to explain this way. So you have year number 1, 2, 3, 4. Depreciation you have 8 lakhs divided by 4 with no salvage value. The revenue without inflation, without I stands for without inflation, as they given, we have copied. So inflation percentage they have given. How this number we have worked out, I would like to explain it here. 660, how we are arriving at is 600,000 multiplied by 1.10, that is equal to 660,000. Next one, 700,000 multiplied by 1.1 multiplied by 1.09, that gives you 839,300. Okay, and so on. That means this arrow mark is not only for this, for the entire column. Same way, it is 8 lakhs into 1.1 into 1.09 into 1.08 equal to 1035936. Right. Next one, 8L into 1.1 into 1.09 into 1.08 into 1.07 equal to 1108,452. How we have done for revenue, same is the case we have to do for cost also. How did you do? 3 lakhs into 1.12. Next one, 4 lakhs into 1.12 into 1.10. Next one, 0 into 1.09. Today it looks very simple. No, at a later point of time when you are just going through, you may not understand. So it is better that you copy it, right, fully. Then profit before depreciation, how do you get? This is column number E minus column number H equal to B. E minus H equal to B. Then here PAT is equal to PBT into 40% only. Why 40%? Because tax rate is 60%. That is the way we have just seen. The institute final answer is worked out like this. 106,738, 106,744. Small 6 rupees difference you have. 3 decimal, 4 decimal, which will have impact that way. Is that clear? Are you clear about this? So there, you cannot be finding out R and all that, because every factor in your cash flow is affected by different inflation rate. Revenue increased by 10%, whereas cost inflated by 12%. So in such cases, it is better that you bring everything into nominal and use one nominal cost of capital and finish it off. Is that okay? Are you clear? Okay. So then impact of technology, impact of government policy. See, all these are generally considered to be a theory area. Now, the next item that we consider as very important is risk and uncertainty. What do you mean by risk and uncertainty? So today I will not be in a position to take any other problem, but I will make an introduction. What do you mean by risk and what do you mean by uncertainty? What is that we should do? Say I have a cash flow given as a project manager. So cash flow will be provided by the company or they will give the inputs, we will find out the cash flow. Correct? Please understand how sure you are with the cash flow. Is it a certain cash flow? If a question is asked, is the cash flow given is certain? You got to tell yes or no. Is it certain? Venkat, is it certain cash flow? So then why you are sitting quiet like others? Whether the cash flow that you have taken up for each one of those years being certain? Answer to the question is no. So therefore, you have uncertainty associated with that. Correct? There is an uncertainty associated with that. How to deal with this? How to deal with this? There are approaches that we have. There are different tools that we have, statistical tools that we have. Two things that we have got to do. One is a risk-adjusted discount method. Then certainty equivalent approach. There are two methods that you have. One you call it out as risk-adjusted discount method. RAD stands for risk-adjusted discount method. The other one is certainty equivalent method or approach. So briefly, I will tell what is that. In case you find time, you can just go through and try of your own. In case you find it, you are not having time or difficult, I will explain in the next class. But I will start with this. Risk-adjusted discount rate is for whatever cost of capital that we take it up normally, say 10%. Because of the fact that cash flow is uncertain, because of the fact that there is a risk factor associated with the cash flow, what is that I should do? Whether I should increase the cost of capital or reduce the cost of capital, what should I do? When I have uncertainty or there is a risk associated with that, whether the interest rate will go up or come down, I am a banker or you are a banker. You are provided with one particular businessman telling that, sir, my business is hospitality. In hospitality, it is medical care, Medicare. Another one, it is a resort. Another one, it is restaurant. Another person is just telling, sir, I'm having a college, medical college coming up. I got the license. Next one, another person is telling, sir, cinema production. I want to take a movie for with Dhanush, Sivakarthikeyan, Surya, Chandra. Likewise, another person is telling, sir, it is agriculture. Another person is telling home loan. Another person is telling, sir, education loan. So people from different walks of life will come to the banker and ask for money. So the banker will not turn down the request made for want of money. He will not be turning down the application saying that I don't have money. See, why then he should be there as calling himself as a banker? So there could be variety of other reasons for which he may turn down. But imagine that all are eligible for that. Now tell me for which of the loan applications where the interest rate will be higher and where you consider that interest rate will be the lowest. So can you just tell where it will be the highest and where it will be the lowest?
Sir, if the risk is high, the interest rate will be high.
Very nice. When risk is more, interest rate is more. So this is a common sense. No, that common sense only we will borrow. When the cash flows are having risk factor associated, I will add a risk premium, say 3% or 4%, and that percentage will be given in the problem. You don't have to just do any extra work. They will give one normal cost of capital, then risk adjusted discount rate they will be providing. So you need to choose the higher one, risk adjusted discount factor, and do just like any other problem. Take a higher cost of capital and discount it, and such NPV, if it shows positive, you accept, otherwise you reject. That's it. This is what you have for risk adjusted approach. Then what is certainty equivalent approach? Certainty equivalent approach is that I would like to associate for every cash flow that the project is giving with certainty equivalent points. If somebody is telling something amongst a circle of friends, people normally tell, he'll be telling lies. I will discount 30% whatever he is telling. That means 30% is going to be gas. Say, you would have seen one advertisement this way. क्या चल रहा है? क्या चल रहा है? What is that advertisement?
Fog.
Fog. So that means what is that they are trying to convey? Other perfumes are only gas. Ours real. Likewise, here we will be having year 0, 1, 2, 3, 4. So certainty equivalent points generally for year 0, it is always 1. Why certainty equivalent will always be 1? Because it is an outflow, you are incurring it now. There is no question of estimate there. Since it is known to you, it is certainty equivalent point is 1. And as the year is passing by, the certainty equivalent points may be dropping gradually and even significantly as the year is going by. Then the cash flows will normally be taken up, say 40,000 outflow, 15,000, 27,000, 18,000, 30,000, like that. Right. Now, what is it we are expected to do? So, cash flow, yes, cash flow, certainty equivalent point, risk-free cash flow. Once I have eliminated uncertainty associated with that, now it will become what? Risk-free cash flow. Now it is going to be 13,500. How come? 0.9 into 15,000. Then 0.8 into 27,000. How much is that, my dear, all of you? So 0.7 into 18,000. How much it works out to, my dear, all of you? Correct? And it is 12,000 here. How come? 0.4 into 30,000. Now, this becomes certain cash flows. Because I have assigned with certainty equivalent points, at this stage, what PV factor that I got to use? So here you will have risk-free, normal cost of capital, and risk-adjusted discount rate. Which of the three I should select? Which of the three I should select? Since my cash flows are risk-free, I am not supposed to take normal cost of capital nor RAD. I should take risk-free cost of capital. It may be 4% or 3% or 6%, and it is less than normal cost of capital. Arrive at NPV, just like any other case. Is that clear? So that is a way we have got to do for certainty equivalent approach. Now, what do you do? We have just done the relationship of inflation to nominal cost of capital. We have done illustration number 1, 2. And we got ourselves introduced to capital budgeting with risk factor associated, or where you have risk and uncertainty associated with that. So in the next class, we will take up on to risk and uncertainty, and that will be by 21st. Today it is 15th. No, this is a Monday. Yesterday 14th, that was Sunday. Hey, yesterday it was a little tired for me. And Vanessa was just telling, sir, I will not be in a position to attend to the class. I have a wedding. Then I thought, okay, See, why a person who is regular to the class, why should we miss? So we will put it on Pongal day. You have just done like that. So next class will be on 21st, Sunday. 4 to 5 FR, 5 to 6 SFM. Is that okay, all of you? Are you clear? So keep studying, and in case of any doubt that you get in between, you please just send voice message or text message, and we will address it. Okay? Is that clear?
Thank you, sir.
Welcome, welcome.
Thank you, sir. Yes, sir.
Okay. Bye.